Welcome to the original Dental CPAs, a division of Naden Lean, first podcast session. I am Dina Jordan and I am one of the principals at the firm, and today I would like to share with you some year-end tax planning techniques and strategies. As the year ends, you may feel it's too late to save any money on taxes. However, even if you've already earned most of your income for the year, you can still make some common sense moves to reduce the amount of taxes you will owe. If you own a business, you have access to an even greater variety of tax reductions and strategies. But even individuals can maximize and take these simple steps to reduce taxes. Our first strategy would be to consider prepaying expenses. Consider expensing up to 3 months of dental or office supplies. For example, if you regularly spend $5,000 per month to buy supplies, consider buying $15,000 worth at year end to get you through the next 3 months. By making a bulk purchase at year end, you'll get a deduction in the current year for that business expense. On the flip side, our second strategy would be to defer income. There are many factors involved in making tax decisions. Generally, the longer you can wait to pay the taxes, the better. The more income you can push into next year, the less tax you'll have to pay this year. Although this strategy can save taxes in the current year, I caution you that it may create problems the following year, particularly if you find yourself in a higher tax bracket. You'll have to balance any current tax savings with the taxes you'll have to pay in the future. However, if your priority is to reduce this year's taxes, the less income you can realize in the current year, the better. And another question that we get at a lot of our year-end meetings was, should we put our kids on the payroll? So to give you a general answer to that question, should you put Jane or John in the office to vacuum? Well, perhaps. While most parents can't get their kids to clean a counter or put away the dishes, perhaps putting kids to work at the office is a good option. Here are some minor tax advantages to paying your children. For example, you can pay your child $6,300 in wages. And since the standard deduction is currently $6,300, the child will not have any taxable income or filing requirements. And you could also still claim the exemption if the child will qualify otherwise. If you pay yourself this income and you're in the 28% tax bracket, you will unnecessarily pay about $1,800 just in federal income taxes. There is also the state component and the self-employment tax. The savings could be potentially as high as $3,200. This will also allow you to set up a Roth IRA for Jane or John. In addition, if you own a single member LLC and your child is under the age of 18, the company does not have to pay employment taxes such as Social Security, Medicare, or workman's comp insurance. You can also avoid unemployment taxes until the child reaches the age of 21. But for S Corps and C Corps, Social Security and Medicare taxes are paid regardless of age. And here are some examples of what your kids can do. They can make the goodie bags. They can restock and organize the supplies when they come into the office. They can feed the fish, stuff and stamp envelopes, help maintain the home office, model for brochures and other marketing pieces of the practice. Our fourth year-end technique would be to add an additional payroll in December. So what you could do is run a third payroll in December, except for the officer and the spouse, if applicable. And what this would make up is the first payment you would make to them in January, but you're deferring the expense into the 2015 year. And of course, this option varies depending on the financial health of the practice. Another common business strategy includes paying your employee bonuses at year end, rather than at the beginning of the year. Tip number 5, if you're considering having a holiday party and you plan to not have it until January, you can still pay for it, book it, and get the deduction in the 2015 year. Tip number 6, profit and discretionary profit sharing. Profit sharing plans can be a powerful tool in promoting financial security in retirement. They are a valuable option for businesses considering a retirement plan, providing benefits to the employees and their employers. This type of plan gives employers flexibility in designing key features. It allows the employer to choose how much they want to contribute to the plan, out of profits or otherwise, each year, including making no contribution for the year. Tip number 7, new equipment. If you have a major capital expenditure coming up, you should consider it at the end of the year for 2015 rather than the beginning of 2016. Currently, under the code, section 179, you can write off $25,000 of equipment that's purchased. Last year, the amount was $25,000 up until late December, where they changed the amount to $500,000. So we're still waiting to hear what that will be for this year. But currently it's $25,000. Another tip that we review at year end with our clients is to review their personal expenses. Make sure the owner should go back and review any expenses paid personally and get reimbursed by the practice by December 31st. This could include auto, phone, gifts, travel, and even meals and entertainment. Speaking of meals and entertainment, this would also be a good time to review the meals and entertainment category on the profit and loss statement. If there are meals that are provided to the staff, they should be coded to employee expense or conventions and meetings. Remember, meals and entertainment are only 50% deductible. Our ninth tip is, are you thinking about buying a new car? If you're considering buying a gas-guzzling SUV, pickup, or van, it may be frowned upon for environmental reasons. But these vehicles can be useful in your business. They also have major tax advantages. Thanks to Section 179 privilege, you can immediately write off up to $25,000 of the cost of the new or used heavy SUV, pickup, or van that is placed in service by the end of the tax year and is used over 50% for business. To cash in on this favorable tax treatment, you must buy a heavy vehicle, which means one the manufacturer's gross vehicle weight rating is above 6,000 pounds. First-year depreciation deductions for lighter SUVs, light trucks, or vans are much skimper. You can usually find the vehicle's weight specifications on a label on the inside edge of the driver's side door where the hinges meet the frame. Our last tax advantage strategy would be talk to your tax expert. Your tax advisor can evaluate your small business's year-to-date financial performances to help determine how much you're likely to owe when taxes are due in 2016, as well as whether you have paid enough estimated taxes for 2015. The strategies discussed here are only a scratch of the surface for the proactive tax planning moves businesses and individuals can make. Business owners who assess matters before year end have many more tax reduction strategies at their disposal than those who wait until the start of the next tax season. Well, that's a wrap for our first podcast session. Please stay tuned for our next one. Again, I'm Dina Jordan and wanted to thank you for taking the time to check out our year-end tax planning tips.